we're aware we're live, just waiting for all the attendees to slot in. Can see you all starting to join through. So we'll just give it a moment to allow everyone to get their audio up and running. And then I'll hand over to Sharon shortly. All right. Pretty much bang on 1 o'clock. So rather than wait for the stragglers, this is being recorded. So if they really want to see this start, they can. So firstly, Sharon, welcome to everyone joining. I'm not going to take up too much time because you're not here to listen to me. Sharon needs no introduction. Still a bit of a superstar because we were doing a presentation for our clients with you, Sharon, back in, I think it might have been late February 2020, early March maybe, when the world was starting to fall apart, and a lot of your predictions came through at that time. So naturally, always very excited to hear what you have to say, and ultimately listen to how you see 2023 playing out, because a lot of us really try to determine which way it's going to go. So as per usual, I'll hand over to you. And for anyone with questions, please send them through. If it's topical at the time, I'll cut in and ask the question. Otherwise, we'll hold it over to the end. So I will step back, shut up, and hand over to you, Sharon.
Thanks, Ben. Yeah, so here we sit in another interesting situation. I've got my slide pack, and hopefully it's all relevant, useful, though there's certainly more questions than answers in it. But as we speak, there are rumblings in global financial markets, first with SVB and other little banks. Well, not so little really, but now the Credit Suisse people are looking sideways at that. That's not new. I mean, it's been known for a long time that they've got issues, but I guess it's always the case that when suddenly people start reassessing risk all at the same time, then things that were parked can suddenly be in the foreground again. So yeah, that's an interesting background. We're seeing people cut their forecasts for what the Fed will do, and even the Reserve Bank, although that's all mixed up with the GDP data that came out this morning as well. So there's always lots of different things going on, lots of uncertainty. The way I'm sort of seeing things are polarized risks getting bigger on both sides, which our forecasts in a way are all but guaranteed to fall between two stools, I would say, insofar as we can see lots of upside risks to inflation if the wheels stay on, and we can see growing risks that the wheels fall off. Yeah, that's hard enough as a forecaster, let alone as a trader or someone, or an investor for that matter, who has to really pick a side. It's very difficult to hedge yourself against risks that are quite polarized in that way. But anyway, I'll try and help you see understand how we're seeing the risks anyway. Starting with inflation, clearly that's one out of the box. New Zealand's there in the orange. We weren't as exposed to the European energy crisis as some others, but nor is our inflation falling particularly convincingly. In fact, it's not falling at all. I think 0.1, maybe it's off its peak. So a year now of inflation sitting above 7. So in that kind of environment, it's pretty hard to argue it's transitory and not something central banks need to worry about. Underneath the surface, it's been getting more and more embedded under the fingernails of the economy. The proportion of prices increasing at least 5% has been steadily increasing over the last 12 months. So although the headline has stayed steady, it's actually been really finding its way into everything. And it's broadened. It started off in goods, related to COVID and the fact that everyone wanted a jet ski since they couldn't go on holiday. But now it's all about services and wage inflation and inflation expectations and those kinds of things. And certainly the story of the last 12 months, well, even longer than that, has been an endless upward surprises on just how strong inflation is and how much work central banks have to do. And fair to say the team transitory, who are arguing that central banks didn't need to respond to this, have gone quieter. Well, they've just transition to the team that's saying central banks have already overdone it and we're going to have an unnecessarily hard landing. They could just chill out, we'd all be better off. Could be. But basically, from where central banks sit, and particularly the Fed and the Reserve Bank of New Zealand, who seem to be seeing things much the same way, at least until the last few days, a hard landing would be unfortunate, but recoverable. Losing your inflation targeting credibility by going too gently would be catastrophic in terms of putting you back into the sort of 80s world where in order to get inflation down, you would have to have a horrific recession, which we duly did in 1990 and 1991. It wasn't the plan, but that was what brought inflation down. You don't want to be in a world where that's what it would take. And that is where you would be if you lost inflation target credibility. So from where they sit, those risks are just not in the same league. And so, but you follow that to its logical conclusion, it means if they haven't already caused a hard landing, then they probably will. That's how they're seeing it. So in terms of the breakdown of inflation, the non-tradables, apart from the GST spike in 2010, it's normally very, very smooth and very stable. Was anything but over 2021 and into last year. Endless surprises on the upside. You can see it's flattened off. I suppose you can take a glass half full view of that, but it's looking pretty comfortable up there. And then the tradable bit, the light blue, that's the bit that normally washes out quite quickly. That's your oil shocks and your exchange rate movements. But at this point, it's everything. And when you look at global risks to global inflation around geopolitics and the rethinking of supply chains, it's also related to pandemic risk. And COVID wasn't even the pandemic they were expecting, and there's still plenty of other things out there that could cause pandemics. And climate change, which seems every month some major food growing regions underwater or being burnt to a crisp. So it seems optimistic to assume that tradable inflation is going to go back to being the benign drag on average inflation that it has been for nearly all of the inflation targeting era. Which does, raise the question, if you're not going to have tradable inflation averaging 1 and your domestic inflation averaging 3 to get your 2% target, if your tradable inflation is going to average 3 or 4, are you going to screw your domestic economy into the ground to get inflation at 2? I think this is a question that's going to be asked. But for now, core inflation measures all above 5, domestic inflation running at 6.6. It's an awfully long way back to 2. We're all forecasting it to neatly fall back to 2, but life tends to get in the way of neat little forecasts like that. For now,
sorry, just a quick question on that. How do you see it being impacted in a political election year?
I think politicians will leave the central bank alone for now. This is a story for sort of down the track. Basically, I can see risks that inflation starts to obediently fall, as it has in some countries, but then gets kind of stuck, still above the target. And then the debate about what is it really worth to us to get inflation down to that actually arbitrary number. Could we live with 4? Please? You can imagine that kind of debate starting in some countries. Of course, the minute you change the inflation target, you lock in higher inflation expectations, and it's the beginning of the end for inflation targeting. So I certainly am not advocating it. I'm just saying I could see how that could devolve. If politicians and even central banks to some extent decide that a huge bunch of the inflation they're seeing is something they can't reasonably do something about, then the question becomes how much do you want to offset it with the stuff you can do something about. But at the moment, I think there's been a misunderstanding that most of the inflation is Putin's fault. Certainly the government's been very keen to push that narrative for obvious reasons. The fact is that the New Zealand government's been running, the New Zealand economy has been running incredibly hot because of a policy mistake, monetary and fiscal policy, massively overstimulating the economy. It was entirely understandable in the fog of war, and our forecasts were no better, but the fact is it was a mistake. And at the same time, the economy's ability to provide those goods was hampered by things like supply chains and by the closed border, stopping the forward growth in the labour force. So we were asking a huge amount of a hobbled economy. And you can see that in this chart, which is firms reported biggest problems. Still, this is December, because we only ask this question every 3 months, but it's finding skilled labour, regulation and paperwork, which is sort of code for the government, high rates of pay, and all your other costs. And those 4 are hugely dominant. So they all either cause inflation or reflect inflation. And then, but the problems the Reserve Bank wants firms to have is low turnover, too much competition, squeezed margins, cash flow even, those kinds of problems, which reflect an economy with spare capacity opening up and a big incentive for everyone to discount their unintendedly high inventories and that sort of thing. Now, anecdotally, that is starting to happen. There's no question that monetary policy is working. It is getting traction, but it is just taking a while. And then the question is, in the meantime, is the problem sneakily getting bigger through inflation becoming normalized in people's price and wage setting behavior? So my question is not, is the Reserve Bank going to be able to slow the economy down, but rather how much of a slowdown is the Reserve Bank going to have to cause to get inflation down? And right now, the additional question is, how much of a tightening in financial conditions is this turmoil in global financial markets going to provide? Because the more that does, the less the OCR needs to do. And markets are taking the view that this is a game-changing event and that central banks are going to be cutting before long. I think it's far too soon to draw that kind of conclusion. We're still in the stage of policymakers throwing a pile of water onto the fire, and we're waiting to see. Literally this week it's gone Monday, oh no, this is fine. Tuesday, oh my goodness. Wednesday, oh, it's all coming down again. Thursday, oh my God. And then who knows what tomorrow may bring. So you'd be a bit mad to change your forecast, I think. And while we're still doing that every 24 hours, but some people are gutsier than me and have done that. There are people now calling cuts in Australia and in the US and in New Zealand by the end of the year. But in the US, there's someone calling a Fed cut at the next meeting. So it was only last weekend that everyone was talking about the Fed funds rate going through 6. So very dynamic situation, I would say. But here and now, there's no question the economy is in a very inflationary state. Of course, it was in 2007 too, just before the wheels fell off spectacularly. But yeah, you can see here what's stopping you expanding your production. An unusually large proportion of firms are saying, well, it's labour. Whereas normally the situation is demand. So if someone came in the door, we'd sell them a widget. Now it's like, well, if they come in the door, we'll tell them there's a 6-month wait for a widget. It's because we haven't got enough workers to produce them. So if that's your problem, then you've got a strong incentive to poach the staff from the firm next door. And that's exactly what's been happening. A huge amount of labour market churn, which greases the wheels of wage inflation in a pretty significant way. And so, yeah, it's the only comparable situation there is the 70s, which also featured very strong labour markets, also a lot of indexation and a lot more intervention in the labour market generally. But you can also see there what a boom bust kind of world it was. And as you can see, we've just had the boom, and now we're sitting waiting to find out how big the bust might be. Just look at that chart. You'd have to say it could be a whopper. Huge mistakes have been made, and there will be a reckoning. We're all talking about, can they achieve a soft landing? I mean, 747 took off vertically. So, yeah, we're hoping for a soft landing. We're all forecasting a soft landing. History would suggest that would be quite the achievement. So, the unemployment rate, the Reserve Bank is forecasting it to rise as rapidly as it did in the GFC. And out there on the street, as of here and now today, that fear factor is just not there. Firms are concerned. They've got Adrian Orr telling them, admitting he's basically deliberately engineering a recession. So obviously business confidence took a hit there. But firms are still hoarding staff because they work so hard to get them. And indeed, we've seen a flurry of job ads and monthly filled jobs. That could be the last hurrah insofar as the labour supply is now easing with immigration and less frenetic hiring. So firms are realising, oh, actually, there is a point in taking a job ad now, whereas there wasn't a few months ago. So I'd be cautious of reading that as a real second wind in the labour market and labour demand. But the Reserve Bank's forecast is that the unemployment rate is rising here and now already today. But the big question is, how much unmet labour demand do we have to chew through before you actually start creating that unemployment? And there's huge question marks around that. There's also a massive regional story. So the likes of Queenstown, that's just completely off the scale, labour shortages. Tauranga is similar. But Auckland and Wellington, the feel is definitely changing in terms of more applicants for jobs, for example. And in the construction sector, firms actually letting people go because their pipeline's drying up very quickly. So it is happening, but the issue is that the non-accelerating rate of unemployment, so the par rate at which the labour market's not contributing to or subtracting from inflation pressures, even on those quite aggressive forecasts, I don't know if you call them optimistic or pessimistic now. I mean, you're talking about people losing their jobs, but it's what the Reserve Bank needs to see to get inflation down. But even on their aggressive forecasts, it's still labour market's still inflationary until the end of the year. And now we've got the rebuild effort, which is going to need quite specific labour, but it's definitely going to be inflationary in its niche. Wage growth is already very strong, whichever measure you look at, stronger than 2008. Unemployment is around a record low, not far off it, even though the labour force participation rates are record high. So, it's not like the US where a bunch of middle-aged white guys just quit working. Now it's, we're literally employing teenagers and people into their 70s, really stretching the definition of the population of working age here. So if your job security is excellent and your wage growth is surprisingly strong, that goes a long way to explaining why consumers have still happily been spending. You can see that here. The dark line is the question in our survey: is it a good time to buy a major household item? And apart from lockdown when the shops were shut, this is basically like the worst time ever to spend money, according to consumers. But you can see in the retail sales, well, first you can see a lot of volatility thanks to COVID, but the upshot is you can see people have not been walking the talk. So yeah, mortgage rates are rising, cost of living is higher, house prices are falling. Adrian was basically threatening people, cool your jets or I'll wallop you with more OCR hikes. And the labour market is just starting to turn. But that starting point for the labour market is a huge support for spending. This is just a few discretionary items of spending. I think restaurants and bars probably being supported by tourism. This is the merchant data. But generally, yeah, the volumes are lower because this is nominal and we've had a lot of inflation, but there's not really any sign of things dropping off a cliff, you'd have to say. And now, of course, we're going to have more pieces of appliances and carpets and furniture and cars to replace all the stuff that was damaged or lost in the floods. So in terms of explaining that dichotomy between what they say and what they do, I think it's helpful to look at the misery index, which is just simply the unemployment rate plus the inflation rate. You don't even have to weight them, just add them together, flip them upside down to turn them into a happiness index, and they match consumer confidence. Unless you've got GST hikes going on in the case of inflation or COVID going on in the case of GDP, you can basically see it explains the dynamics extremely well. And what that implies is that people hate inflation as much as they hate unemployment. So that's why it's such a political issue, and the Prime Minister's under huge pressure to fix the cost of living index. Certainly helps you understand what on earth Rob Muldoon was doing with the wage and price freeze in 1984. So, I mean, there is no quick fix for inflation, but the two things are not the same in terms of the threat to your quality of life. I mean, inflation's not a reason not to spend all your money. Threat of job loss or actual job loss are very good reasons to spend a lot less money. So the upshot is, I think the decline in consumer confidence has overstated the braking impact on spending. And this will be true globally. But then the rebound, if inflation does indeed fall obediently and when people aren't freaking out about GFC2 or something going on, then that would probably overstate the likely rebound in retail as well. So I think for me, this has been a big learning of the last few years, is just how much people hate inflation. I was chatting to Alan Bollard at an event we did together yesterday, and he was saying a university student asked him 2 years ago, sorry, what's inflation? She probably knows now. But yeah, that's the world in which inflation exploded. People were just really, really not prepared for it. And us economic forecasters didn't help by not forecasting. So obviously immigration is really important for the labour market. The left-hand chart shows the dark line there is Australia, job openings per unemployed worker, just a fairly intuitive measure of labour market tightness. The light blue line is job ads in New Zealand. We don't have openings data, deflated the same way. So you can see both of them literally went off the chart. We had to extend the axes. So clearly there's a pretty strong pull from Australia. And you can see there's been a huge surge in departures out of New Zealand. And employment amongst 20-somethings actually fell in the last quarter. And that's because they've left the country. My stepdaughter is 26. Every weekend she's off to somebody's leaving party, Australia or the UK or wherever. But arrivals are up sharply as well. Now, it all makes intuitive sense. You shut the border for a few years, you get catch up. But unfortunately, the migration data is not worth the paper it's written on. Since we got rid of departure cards and Stats New Zealand decided that they should be symmetric and ignore the arrival cards as well. I don't understand. So there's something I'm missing. But anyway, the upshot is you get these crazy revisions. Like just in the last month, Stats New Zealand said, oh, all these Indian people they were away for a really long time, so we thought they'd left the country, and then they all came back again in February. So it turns out that we had to revise immigration numbers from 8,000 to 4,500, and that's just 1 month of data. And you're like, well, they came on work visas anyway. That's my little bugbear. The fact is, even if you knew what the numbers were and they weren't prone to swinging around like a mad thing, the fact is it's ambiguous whether immigration is inflationary via house prices or disinflationary via wages. And so the Reserve Bank has basically said, well, we'll park that, even though it's a major swing variable for the New Zealand economy, we're not going to assume it's going to solve our inflation problem or make it a lot worse. Just wait and see what happens to wages and what happens to house prices, it's a pretty big hole in everyone's understanding of the economy, unfortunately, and better data would help. There you go. So there's our inflation very neat. Our inflation forecast, Reserve Bank's inflation forecast. We all obediently use the Reserve Bank model, which is to ask what do interest rates need to be to bring inflation down to 2% in 2 years' time. The Reserve Bank actually asked 1,000 households, do you think we have a chance of bringing inflation down to 2% in 2 years' time? And the overwhelming answer was no, fat chance. Inflation expectations for businesses are stuck at 6, and for consumers, they're stuck at 5. And as I said, when I look at the risks around inflation, around the potential stickiness of inflation and wages and all those global factors I was talking about, and also you can add in demographics, China's demographics, they're off the cliff and gathering speed, as well as the fact that lots of people are trying to get out of China just in case. And then you can set up your supply chain somewhere else, obviously, but it's an expensive thing to do. Just in case, in time is giving way to just in case, which is a form of insurance, which means you're moving away from the least cost measure. Also, agriculture, it's pretty clear that the green revolution I think it's run its course. Here in New Zealand, we're overstocked. It's not just climate considerations, but water quality, suggesting that, and other countries are going through similar kind of reckoning. So, the upshot is I can see a realistic scenario where inflation falls, but then gets stuck somewhere. It's not our forecast, but that's the way I see the risks tilted. We could also have another global financial crisis and do a 2008. So good luck. Pick a horse. But anyway, cyclone impacts, the Reserve Bank has added 0.3 into Q1 and Q2 for cyclone impacts. So that's rents, construction costs, new used cars, that sort of thing, which seems reasonable. Who knows? Those are the very things that we've been relying on to bring inflation down over the next year, along with petrol prices, which are a lottery, really, as far as the Reserve Bank sits. In response to the events of the last couple of days, oil prices have actually fallen as people are thinking this pretty much locks in a global recession. But obviously the geopolitical situation around the world is pretty fraught at the moment, so you can't rule out that you could see an upward shock to oil prices for some reason on that front. And that would be a very, very difficult situation for central banks. That's kind of your stagflationary situation. If you have a negative oil shock from a high starting point for inflation, central banks can't look through it. They have to raise rates, and the oil price is already bad for growth, and you end up with a sort of a double whammy. That's not a pretty scenario, but right here, right now, oil prices are falling, which feeds into the narrative that what's happening now is going to be bad for global growth, which makes a lot of sense. How can it possibly be good for global growth? But so just a couple of things that suggest here and now that the Reserve Bank might have already achieved more than they know, or possibly overdone it. Investment intentions in our survey versus the Reserve Bank's business investment forecast tracks reasonably well. Of course, that chart looked a lot more impressive 2 months ago, just after the shock value of the November monetary policy statement. And on the right-hand side, the builders in our survey are very, very pessimistic Ignore the lockdown noise. It's a lot weaker than 2008, 2009, whereas the Reserve Bank's forecasting a relatively muted decline in residential investment. But we've had the biggest house building boom in our history. We've got to be at risk of being about to have the biggest house building bust in our history. That's just par for the course, really. So yeah, we're putting a reasonable amount of weight on what builders are telling us. It makes sense. If you're a spec builder, you have trouble selling your previous property, house prices are falling, construction costs are still exceptionally high, bank credit's harder to get because banks can see which way the wind is blowing too. Residential property investors, with that tax change, it's very hard for them to make any kind of leveraged property investment work. So yeah, it's pretty challenging, that spec build. Market is really, so it is just worth noting that while confidence generally is very low, and in a broad picture, all these measures within, say, the business confidence survey are quite correlated. It is essentially a question of, do you expect the economy to speed up or slow down? And you've got Adrian Orr telling you he's going to deliberately cause recession. So of course, an enormous number of firms are expecting exactly that. It doesn't necessarily mean they're expecting a horribly deep recession. So again, it might be overstating the weakness. Employment intentions. Noise there. And so far, our pricing intentions. So we've also added extra questions to our survey. They've only been in there a little while, so it's too short to know really how useful they are. But for what it's worth, intended price increases, intended wage increases, and actual past wage increases to a lesser extent are all moving down in terms of those numerical estimates. So things are going the right way for the Reserve Bank. So again, not suggesting it's not working, just that it's working reasonably slowly, and in the meantime, the job may be getting harder. So globally, the theme has been that labour markets have proven much more resilient than anticipated. But we shouldn't forget, it is the last part of the economy to respond to what central banks do. When you think about the transmission mechanism, they impact confidence, and gradually rolls over into mortgages, and it influences the housing market, construction, and then retail, and business investment, and then finally employment, and then wages. So it can take 2 years for that to run through its course. So I wouldn't say the fact that inflation hasn't fallen in 4 quarters suggests monetary policy can't do anything about it. I just suggest that shows that that's still starting point surprises at this point, showing the job is bigger than they thought. So those endless revisions or starting point surprises on non-tradable inflation have translated straight into upward moves in everyone's expectations of how high the OCR needs to go. So I'm just poking fun at myself here rather than anyone else, but everyone's forecast revisions would look the same. And I can actually stand here with a straight face and tell you, I got kudos last year for my great interest rate forecasting, and yet we clearly missed the wood for the trees. I mean, yeah, we were this much ahead of everyone else, but we were all miles behind the actual true state of affairs. So, back in May 21, we were debating, May 21, we were debating whether the OCR would have to go to 0.5% or 1%. And now we sit here debating whether it's going to peak at 5 or 5.75. Realistically, the OCR could be somewhere between 2 and 7 a year from now, I would say. When you look at how big those revisions have been in the last 2 years, it's been from 0 to 6 pretty much. So I think we all just need to broaden our confidence intervals that we have in our heads around whatever forecast you may have in your head. Anything could happen, essentially. This isn't as useful, but it's not investment advice. Yeah. So, we're now talking about turning points. And the last revision in our forecast was actually downwards, which was very exciting, change of pace there. It's when we saw the Reserve Bank got a helpful down. You can see the downward revision to their forecast for non-tradable inflation. They really had assumed the worst. And similarly for the labour market, it wasn't quite as tight as they'd assumed. And then business and consumer confidence tanked after the statement as well. So we're like, finally, they're getting some confidence channel impacts to give their impact on the economy a bit of a juice. But then nothing much has gone their way since then. The PMI is up, the PSI is up, business confidence is up, consumer confidence is up, monthly job placements are up. It's all sort of looking a bit resilient, which is normally good news, but central banks have managed to turn good news into bad news, just like they managed to turn bad news into good news during the COVID era. So today we had GDP come out at -0.3. The Reserve Bank was expecting +0.7. So some others have interpreted that as a big, important starting point surprise for the Reserve Bank and a reason why they'll only hike 25 rather than 50. We were on 25 anyway, but very, very much in the way we're talking on the fence between 25 and 50. But yeah, at the margin maybe, but the fact is that it's all over the place, the data still, with the COVID impacts and then the tourism rebound impacts, and now there's going to be the cyclone impacts as well. GDP has been next to useless as a guide to how much spare capacity there is in the economy. There's still a mix of strong demand and hampered supply in that data that you can see if you look at the sectoral breakdown. So some of that's disinflationary and some of it's inflationary. So our view is that the Reserve Bank is not going to take much signal from that data because there's just so much noise in it. They're going to rely more on things like the unemployment rate and surveyed capacity utilisation and even, dare I say it, anecdote to try and get a sense of whether they're actually managing to slow things down and get demand lower than supply, which is, we've definitely nowhere near that starting point now. Yeah, so just a bit of a long-term history lesson here for those who don't remember the 60s and 70s. I don't remember them, but so the hallmark of the stable inflation period has been here, the floating mortgage rate sitting well above the inflation rate. So positive real interest rates, you had to think quite hard about why you were borrowing money, what you're going to do with it. New Zealanders thought hard and bought houses. But in the 60s and 70s, those interest rates were often below the rate of inflation. So it's a negative real interest rate. You had a strong incentive to borrow every dollar the bank would lend you, which to be fair was not a lot when interest rates were 20%, but because inflation would inflate it away for you. And people know all this angst about the millennials with their large mortgages, and I do feel sorry for them. They'll be feeling a little hoodwinked at the moment. But the fact is, unexpected inflation does inflate away debt. And that's another reason why I do wonder about how long inflation targeting will be with us, because there's an awful lot of governments with an awful lot of debt in their own currencies. And if things get past the point of no return, they can do austerity forever, which can actually backfire like it did in the case of Greece, because it crunches your economy so hard that your denominator of the GDP to debt ratio shrinks faster than the debt does. So you're still going backwards. Or outright default, which would bring down your entire financial system because all your banks are stuffed with bonds, whether they're SVB or not. And thirdly, you can just keep printing and inflate it away. And that has been the best of a very bad set of options that has been chosen time and time again by politicians through time. That is the reason developing nations can't borrow money in their own currency, because everyone knows how that ends. But rich countries can, and they've been behaving like developing countries in terms of how fast and loose they have played with their money supply ever since 2008, because it appeared you could print as much money as you liked and have no consequences whatsoever. Why haven't we thought of this before? It culminated in modern monetary theory, or magic money tree, as I've also heard it called. And now it's starting to come home to roost. It turns out if you do your best to trash the value of your currency, you may actually succeed. But anyway, the upshot is, at the moment, floating mortgage rate and CPI are roughly the same. In our forecasts, real interest rates do go positive again, but it's much more through inflation falling than it is through the OCR going up. So if inflation doesn't fall that far or that fast, then the OCR will have to do the work instead. So it's not a story of 50 and 75 point hikes. It's a story of endless 25 basis point top-ups as the Reserve Bank runs to stand still and realizes it's on a bit of a treadmill. If inflation gets stuck at 5, then the OCR is going to get stuck at 7 or 7.5. So that's, again, not our forecast, but it's just, yeah, that's what I mean about the possible range of OCR outcomes being a little wider than is currently expected. There's always a temptation as a forecaster to just forecast that far ahead, essentially. A couple more hikes, incrementally, because nothing's worse as a forecaster than a flip-flop. You can lose your credibility quite quickly. And so actually, we all end up making extremely serially correlated errors, as you saw in that previous chart. And any forecaster does the same, including the Reserve Bank. So yeah, when I got kudos for my great forecasting last year, it's because I remember when I started as an economist, my first job was to do a business cycle review of the 1990s. And the conclusion was, dang, we should have tightened earlier and harder because this was much bigger than we thought. And then in the 2008 business cycle review was, the conclusion was, damn, we should have tightened earlier and harder because this was a much bigger problem than we thought. Then, of course, in the next cycle, they did tighten early and it was too soon and they had to cut. And they did that twice. And so then the learning was, don't tighten too soon. Inflation is actually quite hard to get higher. And so always fighting the last war. Got it wrong again. But I'm old enough to remember those earlier cycles, and it smelled like that to me. So that's, sometimes grey hairs can be useful. So household debt is not as high as you might think, given we've had the biggest housing boom in our history. And the reason is that the denominator's been growing very strongly. So household employment and wages. So although, yes, of course, there's been an increase in mortgage lending associated with the 45% run up in house prices that we experienced, we have sort of kept pace with it in terms of the growing household income. Plus, with the LVR restrictions and prudence born of experience, bank mortgage lending has been much higher quality than it was in those crazy years pre-GFC. So the upshot is household debt is not the cap on the OCR that you might intuitively assume. So globally, absolutely, debt levels are a constraint on how high interest rates can go, and we've just started hitting a little bit of that flavour already now. Although what happened to SVB was all about liquidity, not about solvency or about bad debts. But here in New Zealand, corporate debt's still pretty low. Government debt's obviously much higher, but still low in a global comparison. And household debt, because of that income growth, is also not as bad as you might think. I mean, it's high. Can't lie. And that we had a horrible recession when the GFC hit. It lasted about 3 years as far as the person on the street was concerned. And then we actually had a double dip recession in 2010. And obviously we could be lined up for something similar than that too. But household debt is 98% of GDP. Here it is as a share of household income, not to confuse you, but I'm quoting it in those terms because I have the Australian number, which is 123% of GDP. So relative to the size of their economy, Australian household debt is a quarter higher than in New Zealand. That's a lot. And also they have a lot more floating mortgages, like 2/3 as opposed to 10%. So I think that goes a long way to explaining why the RBA feels they got this, they can get on top of it in a timely manner, whereas the RBNZ is like, shoot, whatever we do takes a long time to have an impact, so we better get onto it. So in terms of household debt servicing, it profit at 5%. This is the proportion of household income, disposable income, that's going on paying the interest on your mortgage. Profit at 5%, it's going to go to double digit or a bit more, but it peaked at 16 in 2008. So it's not true that the Reserve Bank's putting an unprecedented burden on households on average, on the median household. Of course, there's a distribution of debt, and there are some pretty freaked out millennials at the one end of the distribution, but monetary policy sets policy for the median. Financial stability worries about the tails, but monetary policy worries about the middle, and the middle's actually fine. So mortgage rates obviously takes a while to roll over. The effective rate of interest to people actually paying on their mortgages is currently 4.5%. It's going to increase to 6.5%, so pretty chunky. About half of debt's going to roll over in the next 12 months. So that's the argument of the people who say they've already done too much, is that this is all baked in and is going to happen. So isn't that enough? And it could be, absolutely could be. But the fact is the OCR is still lower than inflation expectations. So as long as that's the case, how can you possibly be confident that you've rounded on the problem and are reining it in? It's just, probably, but not necessarily. It's all depending on how fast that inflation comes down. So financial conditions, this is going to be more relevant over the next few days and weeks and months, I think. But essentially, this is everything that makes it easier to borrow, so not just the price of borrowing. And you can calibrate it, and it matches GDP quite well. So anyway, the upshot is the fall in house prices has tightened financial conditions as much as the increase in interest rates has. And then that's been exacerbated by tighter credit conditions, as is always the case at this point of the cycle. Offset on the other side by quite a weak exchange rate relative to our commodity prices. But weighing it all up, financial conditions are the tightest since 2008. So you would expect the economy to slow, and it definitely is slowing. Now, because we don't forecast them, we've held constant equities, credit conditions, and credit spreads, but all three of those things are certainly things that are going to be worth keeping an eye on in the next while. Because they all have the potential to tighten financial conditions and thereby mean less work for interest rates to do. And certainly that's what the market narrative is at the moment. So yeah, it's the house price cycle. You can see basically we took a 5-year housing cycle and compressed it into 2. Yeah, that was a wild ride. So crazy house price boom, and now we're into the bust. They're already down 16%. We're forecasting minus 22%, which, believe it or not, is a soft landing. So since I never thought I'd hear myself say that a 22% fall in house prices is a soft landing, but that just reflects the fact that they went up 45%. So in nominal terms, that forecast would take house prices, leave them a little higher than they were pre-COVID, and nominal house prices do matter enormously for things like negative equity. If people have to sell their houses, how much debt they walk away with. But real house prices are where the rubber hits the road for sort of sustainability, I suppose. And that's a 32% fall in real house prices. So it's the other little silver lining of inflation. As well as inflating away debt, it greases the wheels of relative price adjustments. And we have a massive job to do in terms of getting the relative price of housing down. So that 10% that's come through wage increases doesn't put people into negative equity, doesn't cause financial stability problems. In fact, it helps out with that. It does, of course, lead to much higher interest rates, which, yeah, but there is a bit of give and take there, I would say. So how is that a soft landing? Well, if you look at the level of real house prices, they were a lot lower in 2010. To get there, real house prices would have to halve. That's not the bottom either necessarily, though, because if you look at 2010 on this chart, you can see real house prices relative to incomes were, what's that, 30% higher than they were in the late 90s. And we had a whopping house price cycle in the 90s, which saw real house prices end much higher than they were before as well. So if we had more history for that chart, it would still show lower and lower. So there isn't really a bottom for real house prices in terms of the fundamentals. Affordable is considered 4. We haven't been there since the turn of the century. But yeah, this is the biggest risk to our economy in a GFC type environment, is that you could see unemployment gap higher, lots more people to have to sell, and therefore prices gap lower. Whereas so far it's been very orderly, very few people have to sell, so they list their house, they're offended by the price they get offered and take it off the market again. You can do that if you don't have to sell, but if you do have to sell, you can see prices fall much more quickly, and then that could obviously have feedback loops into confidence and spending and back into employment and round and round.
Just jumping on that point for a moment. So how do you think the banks will behave when the loan to value ratio is potentially reset? Those that purchased more recently aren't over the magic 90 or 80% mark, are still comfortable paying their mortgage. They've got either the savings or they've got a job. But the bank's book could potentially be repositioned with higher LVR, sorry, I should say. Are the banks likely to step in that scenario, or are they likely to let it play out if they can still service the debt?
Absolutely no incentive to crystallise a loss on a performing asset. So yeah, no, you're not going to whip the carpet out from someone and say, sorry, you're now.
What about the Reserve Bank stepping in and saying that the bank's overall book has got too much in that high LVR bucket, and there'll be no pressure from that end, do you think?
It could definitely influence banks' appetite to continue to do lending at higher LVRs for sure. If the quality of their existing book has deteriorated, then yeah, you'd expect that to impact the appetite for more lending at high LVRs for sure. But yeah, at an individual customer level, if they're paying their mortgage, great. Let's keep going with this, people, because all our incentives are very aligned for you to dig your way out of this hole. There is no conflict there. It's in no one's interests to crystallise a loss on a performing loan.
And would you see the same story on the commercial side?
Yeah, well, again, you don't want to force people to sell an asset if you don't have to, but interest cover ratios are obviously under a bit of pressure at the moment. It is a very lumpy kind of space, and the higher rates go, then the lumpier it gets for sure. And you've seen banks have very, very little appetite for new commercial lending for quite some time now. And that's because there's a few grey hairs in that part of the bank as well who have seen this before. But yeah, the same sort of logic applies. You don't want to force someone to sell an asset at a loss if they don't have to, and you don't require them to. So the threshold is still pretty high. Of course, kicking someone out of their home has that whole extra element to it in terms of the Herald front page test, doesn't it? So yeah, that's probably an extra protection, I would say, is for home owners that commercial property owners don't have. It's been interesting actually in recent years. Some high value individuals have moved into commercial property as a way of getting around the LVR restrictions. Yeah, I hope they understand the extra risk that is associated with that, in particular the risk of a commercial property sitting empty for quite a long time in a downturn in a way that a house is not likely to. I mean, you can find a tenant if you lower your rent enough for a house. That might be more challenging for a commercial property potentially.
Sure.
But yeah, we don't spend a lot of time forecasting the commercial property market because well, in fact, we don't even forecast it, but it doesn't have the feedback loops into the economy the way residential housing does. But speaking back to housing, you can see there's just a few little green shoots there in the Auckland market. Interesting. And our mortgage brokers are reporting that first-time buyers are very active. Like, what are they? You mean active as in running for the hills? But no, apparently not. Yeah, so there seem to be a few people who think houses are bargains at these levels. Whew, I certainly would disagree, but there you go.
Low first home buyers for about 1 day, wasn't it? And then they shut the door on them just as fast as they opened it. So that was an interesting turn of events.
Yeah. Yes. So yeah, back to construction. Yeah, so you can see consents are following the lead given to us by our fabulous business outlook survey. If any of you guys run a business and are not in our survey, we would absolutely love to have you. And I've got a QR code at the end, so be ready with your phone. But yeah, as I said, the maths is very difficult, so that does make sense. But now we will have some extra construction activity for the cyclone. But unlike Christchurch, it's going to be a lot more roads and bridges than it is houses. But you can see construction shot out of the blocks in terms of its recovery from COVID, and now it's leading the way down. Makes sense that it's the most interest rate sensitive sector. It's also worth noting though that those employment intentions are not low. They're lower, but they're not low compared to where they sat before COVID. A very strong regional element like Queenstown and Tauranga labour markets are incredibly tight, but in some other places a bit of capacity is starting to open up. The construction costs should have been falling by now, given what's happened to house prices, but they have been holding up. But anecdotally, they are increasing by less now. There'll be pockets of strength, carpet layers in Auckland, for example, but we would expect that to fall and to be a decent drag on CPI in the near term. So yeah, there are good reasons to expect CPI inflation to fall. My question is whether it will obediently keep falling all the way down to 2 with a nice linear fashion. Global commodities, yeah, they were obediently falling, and then they got a bit of a second wind with the China reopening, but now I would expect them to be under downward pressure again with what's happened and everyone thinking recession after all. Whereas the theme of the last few months has been, actually, look, even the UK and Germany and other places now, and Germany didn't end up having a massive energy crisis over winter, and the wheels haven't fallen off the US labour market. And, okay. And of course, the China reopening, which China's economy's got enormous problems, including a popping property bubble and challenging demographics. But there's, they've locked it up for 3 years and now they're letting it go. So there will, of course, be a boost in demand from that. But shipping costs way down again. Basically, people are going on holiday again instead of buying boats or whatever. So the demand for goods to be moved around the world has decreased. Global supply chain pressures easing substantially. And firms in our business outlook survey reporting less disruption. But of course, now we've got our own localised disruption in the North Island with the state of the roads. And we've got to remember, winter is slip season, not summer. So now we've got these saturated soils. These slips are likely to continue to be a problem for the next 6 months. And it went a bit under the radar, but it's not just roading. There was the massive power pylon that carries one of 2 cables of electricity into Northland. A slip happened, looked from the picture like about 15, 20 metres away. The geotechnical people came in and said, we can't stabilise this. You're going to have to turn this off, rebuild it somewhere else, which leaves Northland with 1 power cable. So if anything happens to that one in the next 3 months, all of Northland will lose their electricity. So our whole infrastructure is much more fragile than we had appreciated. And so obviously it's going to be a big spend up on that, which is going to have to be phased because we've got limited resources. And people are going to get very, very angry about the slow rate of progress. I know that already. We went and spoke to the ANZ staff in Nelson to ask them about their recovery from their floods, and the answer was that it was painfully slow and stop-start, and lots of logjam bottlenecks, like geotech engineers and whatever. And now we've got that on a much grander scale. So yeah, in terms of New Zealand's commodity prices, milk and oil tend to move very closely together despite not being substitutes. So we just have to sort of win some, lose some. We would hate to see a big oil spike at the moment, but dairy farmers obviously aren't too stoked about milk prices falling. The New Zealand dollar, as I mentioned, has been surprisingly weak given where dairy prices are. That's a US dollar story, so we shouldn't take it personally. But our current account deficit's running at nearly 9% of GDP, which is the highest in decades. So yeah, maybe we do have some homegrown factors that are suppressing our exchange rate as well now, I would say. So yeah, a few global charts. You can see bond yields. The bonds have been going, whoa, inflation, oh, but this is going to cause a recession. Oh, inflation, but this is going to cause a recession. But the inflation narrative has been dominating. But you can see there the move over the last week. People are now going recession and basically saying that the central bank's going to blink. So yeah, time will tell. And so far as inflation caused this mess in the first place, it's not clear that capitulating on controlling inflation would help. But it's one thing to trade off inflation stability and growth stability. It's another thing to trade off inflation stability and financial stability. And you can imagine scenarios where if this thing blew up spectacularly with a big fiscal cost, there would be no option but to keep printing money. So the 1970s are not that far away. Of course, inflation targeting is supposed to stop all this from being a remote possibility, but the fact is, inflation isn't always the worst possible outcome. And at the end of the day, it's politicians, quite rightly, they're accountable to the public, who make the decisions, not the central bank nerdy committees. Equities have also been going, inflation tightening, but recession, but growth is good, but that's bad. And yeah, they've been very confused. But you can see they don't generally like high inflation. It's hard to spin high inflation as a good news story. And obviously they don't like troubles in the banking sector. You can see the stress is emerging there. Credit spreads worth keeping an eye on now, particularly now that people have started to reassess risks. The dark blue one there is China property development, essentially. The beigey one is Italy. You know, Euro's structural issues have not been resolved. It's just all been papered over with freshly printed money, and their ability to keep doing that has obviously now been hampered by high inflation. They can't pretend it was all about boosting inflation anymore. It is fiscal union by stealth. And the light blue is the US junk bond market. Now that was very, very frothy over the COVID period, but the borrowers weren't stupid and they recognised a good opportunity when they saw it, and they borrowed really long. So that's a problem for another day. And then crypto, which, yeah, turns out giving 25-year-olds billions of dollars and not asking any questions about what they're doing with it led to some stupid decisions. Who could have seen that one coming? But the dark blue line there is ANZ customers' purchases of crypto. So everyone bought the peak. They're a bit late to the first party. Well, that wasn't crypto's first party, but the 2021 party. Yeah, but of course, I'm not having a crack, particularly at ANZ customers here. It was the peak because everyone was buying it at that time. Less enthusiasm for buying the recent dip, you'd have to say, although the percentage increases in the likes of Bitcoin have been quite impressive. Yeah, an asset for the strong stomach currency. And as I mentioned before, the current account deficit. So it isn't just inflation saying that actually New Zealand, you've been on a bender, detox time. So importing heaps of goods for consumption mostly, but also some investment. Also big government deficits, running up debt and spending lots of money. We lost tourism and foreign students as a source of export earnings. And now interest rates are going up and we're a net debtor nation. So on balance, that's bad for us as well. So yeah, team effort, but pretty much all of the components of the current account have worked together to push us to a deficit, the likes of which has not been seen for literally decades. I think 1970 something, not sure. Chart doesn't go back far enough. So normally ratings agencies start looking sideways at about 8. So we've already had some comments from S&P that they might downgrade us if things don't start turning around very soon. I think they've got other things to worry about right now than us. Who knows, maybe we'll be the Switzerland of the South Pacific since we've got such a well-capitalized, plain vanilla banking system, but we do have vulnerabilities, and current account is one of them. If the world decided it didn't want to fund our lifestyles anymore, then we would face a pretty sudden reckoning in terms of our purchasing power. So yeah, the point is here, no matter what you think about inflation and how transitory or persistent inflation is going to prove, it's not just that's showing that we have been spending well beyond our means for quite a long time as a nation, and now need to cool our jets, in the immortal words of Adrian Orr. So finally, on the left, if you do help run a business, big or small, and think you have some insights into what your business is seeing, we'd love to have you in our Business Outlook survey. That's every month, just takes a couple of minutes. And on the right-hand side, that is a link to subscribe to ANZ Research Publications. If you don't already, it's a self-service portal. Some things are limited to ANZ customers, some things are limited to wholesale customers because of financial advice legislation, but there's also quite a lot that's a free for all there as well. I'll leave that up for a bit and hand over to you, Ben, for any Q&A.
Yeah, thank you very much again. So yeah, leave that sitting up on the screen. I've got a couple of questions here to fire through. So looking through Reese's question there, ultimately, I guess if I look through his question, why do the central banks sort of over loosen and then over tighten? You kind of alluded to it a little bit before with regards to either going too soon or going too late or waiting too long. What is that? Is it?
I would say it's because forecasting the economy is impossible. Because at the end of the day, the economies are made up of people who are making up their own minds and behaving in not entirely rational ways necessarily. And data is imperfect. It's often really lagging. You know, today we got the data for what happened in the economy in the last 3 months of last year, which was nearly 3 months ago now, the end of that period, nearly 6 months ago since that period started. And then the data is at best a very rough proxy for what actually happened. And then, you know, the data, like some of it's complete rubbish, like migration, CPI is only quarterly. So yeah, you've got a measurement problem, and then you've just got an unpredictability problem, and then you've got the fact that monetary policy takes 18 months to 2 years to take effect. Another chart that I don't have in here right now is the Reserve Bank's best guess of the neutral OCR. So that is the rate that's not stimulating or cooling the economy. And that moves through time. No one knows what their number is. They have to guess it based on what they're seeing on first, the impact they're having on the economy, which tells them from 18 months earlier, and secondly, inflation expectations. Their range of estimates for that goes from 2.4 to 5.4, which means that the current OCR at 475 could be slammed on the brake and we're about to smack our heads into the windscreen, or it could be flat, it could still be on the accelerator and the car's still gathering speed. We won't know for 18 months. So, to me, it's not a question of how can you forecast better, because it's always going to be very, very difficult. To be honest, we can forecast maybe 3 months into the future on a good day. So it does raise the question, is it useful to even try to fine-tune the economy with monetary policy, or should we just leave things the heck alone? I think that's a debate that's to be had too.
How much do you think the 70s with the inflation peaking again after the brakes were taken off, do you think that will weigh on particularly New Zealand's central bank?
Yeah, absolutely. Central banks be well aware of the mistakes that were made then. And so I think the people who are calling for the Fed to cut in the next meeting are perhaps underestimating the grey hairs at the Fed, who, if that chart of the 70s, inflation went from 10 to 6, and everyone would have been going, excellent, happily extrapolating it down to 2. It then shot up to 10, and then fell to 5, and then went up to 18. So, it doesn't do things like our forecast. It's the high inflation is incredibly volatile and unpredictable inflation. So take anyone's inflation forecasts with a grain of salt. And so for the Fed to assume that this is going to tighten financial conditions enough sufficiently to make inflation go away would be heroic, or just foolish, I would say, actually. But the pressure on them to do that will be intense. Of course it will. So you can easily imagine a scenario where central banks don't end up doing what is actually necessary to get inflation down, because the problems that are front and centre right in front of them are just too big to ignore. And you know, we do have trouble seeing past the ends of our noses. You saw that, for example, when the Labor government cut the fuel tax subsidy, completely inconsistent with our carbon targets, but cost of living, can't see past the cost of living. You know, that's how politics works, and it's the worst form of governance apart from all the others. It does encourage short-term thinking.
A couple of questions here that have been thrown at me separately. So just coming back on the mortgages or loans, I should say, against houses. So do you know off the top of your head sort of what percentage of homes in New Zealand actually have debt against it, and what that average level of debt is for those properties versus those that will be unimpacted by rising OCRs?
Yeah, so somewhere between 30-35% of households have a mortgage with a positive balance on it, an outstanding balance on it, and a bit under a third of households have a house with no debt on it, and about a third are renting, give or take a couple of percent. So, you know, the Reserve Bank is smacking about 10% of the population with a sledgehammer in order to get average consumption down. There's nothing fair about monetary policy. And of course, it's not a random sample of the population either. It's the millennials and the people in their 20s who have the largest amount of, into their 30s, who have the largest amount of debt, and are therefore the most exposed to this. They're also the people who have no memory of interest rates ever going up, and were most likely to believe that interest rates would stay low forever. So, yeah, as I said, they'll be feeling a little hard done by. And at some point.
On the other side of that argument, then those with savings potentially would have an inflationary impact because they're actually getting a return on their cash deposits now versus those that are obviously paying more out of it. A couple more here. So just before we tie it up, just mindful, it's just gone 2:00. Tax take. Do you see with an election coming through, whether the government potentially in a situation where they're going to have lower, through a recession, assumably lower revenues, whether they're going to have to bump up tax take to ultimately pay off, well, the impacts we've seen of the cyclone and obviously the COVID hangover?
Yeah, so I mean, I think in some way it's an opportunity to do what they wanted to do anyway. You know, the tax working group's conclusion was that we are far too dependent on income tax, but Jacinda Ardern had ruled out a capital gains tax, but Chris Hipkins has proven himself to be John Key, essentially, smiling assassin, and also happy to throw stuff on the bonfire, very pragmatic man. So yeah, I would think he would feel that he has the ability to bring in new taxes if he wants to, and certainly New Zealand is unusual internationally in having essentially no tax on wealth at all. So I would say that is definitely a possibility. The latest emission trading scheme auction just failed, and that would be that's another $1 billion shortfall in the budget that they would have thought they were going to have going into May. Yeah, I had actually wondered if they might remove the GST on the fresh fruit and veggies as part of the cost of living measures, because he would have gotten a very short list of things he could actually do to help with the cost of living. But I'm just not sure they'll conclude that they can afford that now. I haven't done the back of the envelope calculations, but they could essentially offset that with a higher tax rate, a new tax bracket, essentially for people earning, I don't know, $250,000 or something. But they really need to adjust the tax brackets for the normal tax rates that we have now, because the bracket creep is obscene. Essentially, you know, the minimum wage nearly puts you into the 30% bracket. Right. In a world of 7% inflation, they should be indexed to inflation. It's a very deliberate choice not to do that, but they should be indexed.
Yeah, okay. Well, I think just in the interest of time, there's no last minute questions come through, so we might just call it quits there, and thank you for joining us on behalf of PWA. So we got Grant, Roger, Jack, Kerry and myself. So welcome to Kerry as our latest and greatest advisor who's joined the team. Sharon, once again, always a pleasure. We love having you around, so I'm sure we'll knock on your door soon. We always get a lot of interest when you jump in, and seeing these Zoom meetings are working. I think we're getting a lot more uptake of people that are happy to jump in for an hour than jump in the car and head up the road and contribute to Auckland's amazing traffic scenario. So I guess we can thank COVID for that. So that's awesome. Thank you once again, and we'll be in touch.
You're welcome. Good luck out there, everyone. Hang on to your hats.
Thank you all. See ya.